Welcome back to Talk Tickers. Today, we are stripping away the noise and looking at maybe the only business model in the world that actually likes it when the global economy is on fire.
It's the ultimate toll road. We are, of course, talking about the CME Group.
And we are breaking down their Q4 2025 earnings call, which just happened this morning, Wednesday, February 4th. If you believe volatility is the new normal, and let's be honest, it kind of is, this is the deep dive you need.
It really is. And looking at the tape, the market's reaction today was, well, it was a bit confusing. You have these historic record-breaking numbers.
And the stock just sort of shrugged. It was a very polite golf clap. It closed at $294.62, up just, 0.53%?
Barely green. And that's the classic show me reaction from the street. The headlines are fantastic, absolutely, but investors are looking at the price tag for future growth and raising an eyebrow.
So it's a battle between look how much we just made and look how much we're about to spend.
Exactly.
Okay, well, let's start with the how much we made part, because wow, the scoreboard is impressive. This was a beat. Adjusted EPS came in at $2.77, just nudging past the $2.75 consensus.
A solid beat.
And revenue for the quarter was $1.65 billion. That's up 8% year over year. For the full year 2025, they brought in a record $6.5 billion.
And the volume backs that up. Average daily volume, or ADV, for Q4 was 27.4 million contracts a day, up 7%. But, the number that really jumps out to me is the cash.
Oh,
they are just flush. They ended the year with something like $4.6 billion in cash on hand. This isn't a tech company burning cash. It's a mint.
that is a fortress balance sheet. That sleep well at night money right there.
Right. And they're putting it to work. They spent $256 million on buybacks in Q4, and then they dropped another $276 million just in the first few weeks of 2026.
And the dividend story is huge.
Oh, it's massive. They paid out $3.9 billion in dividends during 2025. That is a serious, serious shareholder yield.
So let's get into the engine room. Management on the call kept talking about this risk always on environment. And what struck me was that this wasn't just an interest rate story.
No, it was diversified. Records in energy, metals, agriculture, it was across the board.
But I want you to really break down the road here. Why do the big institutions stick with CME? Because it's not just inertia, it's something deeper. It's about capital efficiency.
That's the word. This is the really sticky part of the business. They threw around some huge numbers on margin offsets.
Okay, let's break that down for someone who isn't running a multi-billion-dollar macro fund. What does that actually mean?
Okay, so simply put, imagine you're a big fund. You have a trade that bets interest rates will go up, but you also have a trade that bets gold will go down.
A hedge, basically.
Exactly. Now, if you do those trades at two separate exchanges, you have to post a full cash deposit. That's the margin at both places. That ties up a ton of your capital. It's just dead money sitting there.
Earning you nothing.
Right. But if you do both trades at CME, their clearinghouse looks at your whole portfolio together. It says, wait a minute. These risks kind of offset each other. You don't need to post $100 million in collateral. Maybe $20 million is enough.
So you get a discount on your safety deposit because your bets cancel each other out.
Precisely.
Yeah.
And the scale of this is it's mind-blowing. In Q4, CME clients saved an average of $80 billion.
A month.
Per day.
$80 billion a day.
Per day. That's $80 billion of capital that those funds could use for other things, for more trades, to earn interest, whatever. That's why you don't leave. The cost of leaving is just too high.
It's a gravitational pull.
Yeah.
The more you trade with them, the cheaper your capital costs become.
And they're even expanding it. They mentioned their deal with the DTCC, which is, the plumbing of the bond market. That arrangement saved firms another $1.5 billion.
Which gives them just incredible pricing power. I mean, if you're saving a client that much money, you can definitely charge them a little more for the service.
And they are. Transaction fees are going up on April 1st. Market data fees already went up on January 1st, about a 3.5% increase. Management thinks they'll get a 1 to 1.5% revenue bump just from that, assuming volumes stay flat.
Which is a big if,
Yeah.
But they just posted a record January with almost 30 million contracts a day, so the demand is there.
The demand is definitely there.
Okay, but this is where the story gets tricky, and it's why the stock was flat. We have to talk about the expense bill versus these new growth engines.
This is it. This is why the stock didn't pop 5% today. The 2026 expense guide it's a big number. They're guiding for adjusted operating expenses of $1.695 billion.
That's a big step up.
It is. And investors always get nervous when the bill comes due before the new revenue actually shows up.
But look at where the money is going. It's not just corporate jets. They're building whole new ecosystems. Let's start with crypto. 2025 was a record year for them there.
ADV was up 92% in Q4. It's exploding.
And now they're adding Cardano, Chainlink, and Stellar Futures next week. They're moving out the risk curve from just Bitcoin and Ether.
And the big one.
The big one. 247, trading for the entire crypto suite, starts in Q2 this year. That is huge. They're finally meeting the crypto market where it actually lives, which is all the time.
It's a necessary move. I mean, you can't be the institutional home for crypto risk if you're closed on a Saturday night when, Bitcoin moves 20%. The spot market never closes.
So they're closing that gap. They're becoming the bank that never sleeps.
Exactly. But running a federally regulated exchange 24/7 is incredibly expensive. You need staff, surveillance, risk management, all at 3 a.m. on a Sunday. That's where some of that money is going.
Then you have the prediction markets. This partnership with FanDuel is wild.
It's the gamification of the exchange, but, in a suit and tie.
68 million contracts traded in just the first 6 weeks.
Yeah.
They're expanding into everything. Financial indicators, economic data, sports. It's like betting on the Super Bowl, but cleared through the CME.
It is. But again, that brings us to the expense line. A lot of the spend is also the Google Cloud migration. They spent $29 million in Q4 alone on that tech. That ultra-low latency data center they're building won't even be ready for client testing until 2027.
So that's the long game. You're building the racetrack for the next decade of trading. But investors today are looking at that $1.7 billion expense number and saying, okay, prove it.
That's it. They're in show me mode. But there's another layer here we have to talk about, and that's the regulatory moat.
This brings up my favorite part of the call, the story from Terry Duffy, the CEO, about the silver market. I love this because it just flips the usual logic on its head.
The silver volatility anecdote, right?
So usually when an exchange raises margins on a product, it's like hitting the brakes. It gets more expensive to trade, so volume dies down. But Duffy talked about how they raised margins on silver because volatility was spiking.
And you'd think, logically, that would kill the rally. Price goes up, demand goes down.
But it didn't. Silver hit new historic highs after the margin hike. The retail traders, the institutions, they all just kept buying. Duffy's point was the customer is very healthy. If they want the exposure, they'll pay whatever it costs.
It's a testament to the inelasticity of demand when there's a frenzy. When you need that hedge or you're chasing that trend, the cost is secondary. You just pay it.
It's amazing.
But I want to pivot that regulatory point to the prediction markets because Duffy was very, very clear on the legal side.
He basically said, we are not getting into legal fights with states or casinos.
He was adamant. They will only list contracts that the CFTC deems to be swaps. If it's regulated by their main regulator, they'll do it. If it falls into some gray area with state gambling laws, they are staying far away.
Which is smart. And he also said they'd look at big political contracts, like the presidential race, but they are avoiding small local races. They don't want to get into the weeds of local politics.
And that brings us to maybe the biggest regulatory catalyst of all, the Treasury clearing mandate. The SEC is pushing this rule that will require central clearing for U.S. Treasuries.
And CME is just sitting there with their net open, ready to catch the fish.
They've got the clearinghouse approved and ready to go. I mean, if a huge portion of the U.S. Treasury market is suddenly forced to use a clearinghouse, CME is perfectly positioned. The government is essentially creating new customers for them.
So putting it all together for the listener, you have a record 2025, you have a monster January start to 2026, you have price hikes coming, but the stock is flat because the expense bill is climbing to nearly $1.7 billion.
That's the whole story in a nutshell. The beat was driven by volume, which can be volatile. The concern is the structural expense hike. Investors want to see that FanDuel and 24/7 Crypto can actually pay for the Google Cloud migration.
It's a prove-it year. And with a start like January, so far, they're proving it.
They are. The world remains a chaotic place, and for them, that chaos is the product.
All right, that brings us to this segment where we stop being responsible analysts and start thinking like reckless traders. This is not financial advice segment.
And please remember, we are just voices in your headphones. We are podcasters. Do not trade based on this. This is just an exploration of an idea.
Exactly. But if I were pitching something wild but plausible, based strictly on what I heard on this call, I've got one. I'm calling it the Silver Squeeze Momentum Margin ARB.
Okay, I like the name. Walk me through the logic here.
It's based entirely on what Duffy said. Usually a margin hike is bearish. It's the exchange trying to cool a market down. It's the brakes. But he just told us that in this environment, the brakes don't work. The rally blew right through them.
So you're saying the signal is the hike itself?
The signal is the hike. The trade is this. You monitor the CME clearing advisory notices. The absolute second they announce a margin hike on a commodity, say silver or gold, because of elevated volatility,
Yeah.
you go long. You buy calls. You do not sell.
That is completely counterintuitive. You're buying into the friction. You're betting against the safety mechanism of the exchange.
Yes, because the margin hike is the exchange telling you they see frenzied, risk-always-on behavior. If the institutional and retail demand is strong enough to trigger the hike, Duffy just proved it's strong enough to absorb the cost. You're trying to ride the melt-up that the exchange itself is trying to dampen.
So you're betting that the animal spirits of the market are stronger than the regulator's brakes. It's a momentum play on market psychology.
It's wild.
Yeah.
But based on what the CEO just said, it's also plausible.
It is plausible. Just keep your stops very, very tight. If the margin hike actually works this time, you need to get out fast.
Always. So, to recap, CME, a record 2025, they're raising fees on April 1st, and they're spending big on the future cloud and crypto for 2026.
Volatility is the product, and right now, business is booming.
Keep your risk managed, and we'll see you on the next print.